Good morning and welcome to the Monday 23rd of November Smart Financial Planning Review of the Weekend Papers. Instead of actually reviewing the weekend's papers this week, I thought I would give you a rundown on how successful it's been to make investments over the last 10 and 20 years. You might wonder why, but I've been asked recently to contribute to one of Manchester's business magazines to discuss the subject of equity investing. Is equity investing dead, was their premise. And I very strongly argued that it's not, explained to them why I thought it wasn't, and realised it might actually be information that was of interest to you as well. So here's why. The premise of equity investing being dead would of course be around the fact that investing in equities, i.e. companies, does not make money. Well, over the last 10 years and over the last 20 years, that would not have been the case. If you were to invest in a passively invested, globally diversified equity portfolio over the last 10 years, your average return would have been 5.07% per annum. Over the last 20 years, that would have been 9.97% per annum. So clearly, investing in equities is not a bad thing to do. You might say, well, what was inflation over that period? Well, over the 10-year period, inflation was 2.63%. And over the 20-year period, it was 3.44%. So even over the last 10 years, where we've had two enormous stock market crashes, the tech boom crash in 2000 and the credit crunch crash last year, you're still making money, significant amounts of money, a significant return over inflation. It is also worth just looking at what is the total return over that period. So over a 10-year period, if you'd invested £100, how much would that £100 have grown to? And the answer is approximately £160. And what was the impact of inflation? That took it up to approximately £130. So you've still outperformed inflation at twice the level over one of the worst investing periods with two massive stock market crashes. Over the 20-year period, much more dramatic figures. The result of inflation would have doubled your money and a little bit more. You would have had 109% growth in your money purely as a result of inflation. But full equity portfolio, 700% growth. So, to my friends who asked me that question in the local business paper, the answer is very obviously no, equity investing is not dead. What does that tell us going forward? Well, it tells us that although investing in equities is something that can be high risk, and I mean high risk in the sense that it's very volatile, fund values going up and down, over the long term, even over very bad periods, there's still a very positive gain to be had. If you take it over a longer period, the 20-year period, 700% increase in your money against 100% or 110%, I should say, increase in inflation. So a massive premium. Bearing in mind that most investment decisions that you're going to make probably do have a 20-year horizon, either in the run-up to retirement or the run-up to your retirement, and then you start to draw some money and maintain your investments. In many cases, it could be longer than 20 years. I don't think there is anybody who would be unhappy with returns of that sort over that time period. And for those that would, it probably would be a risk element. And in that case, we wouldn't obviously look to expose anything like all of their money to equities. We would look to invest that money in much lower risk areas. So just one final thought for you. Over a 20-year period, if instead of investing 100% of your money in equities, you invested only 40% of your money in equities, with 60% of your money in gilts and cash, low risk areas, you would still have had 480% return on your investment. So that's 480% exposing only 40% of your money to the stock market. So it really does prove the point about risk and return. If you're prepared to take more of the risk, you get approximately 700% return. If you're prepared to take less than half of the kind of stock market risk, you're looking at a return of 480%. And if all you do is put your money in a place where you keep pace with inflation, 110%. The story says it all. Look forward to speaking to you next week. Have a nice week. Bye bye.